In scenes eerily similar to previous bank runs, Silicon Valley Bank depositors panicked and led to the collapse of a major financial institution. It was the 18th largest bank in the United States, but they made two fatal mistakes. Here's what happened at Silicon Valley Bank and why it matters to you. Silicon Valley Bank, or SVB, was founded 40 years ago by a group of entrepreneurs who wanted a bank that would specialize in serving tech companies. By specializing in that industry, they hoped to serve startups better than other bank options. This can be especially helpful to new companies since many entrepreneurs benefit from experienced investors that can help them navigate the challenges of a growing business. The strategy worked. Silicon Valley Bank became a huge commercial bank with assets of over $200 billion and entered the top 20 largest banks in the United States. But it all came crashing down. To understand what happened, we need to talk a little bit about how banks make money. The simplest business model for banks can be explained using savings accounts and loans. Banks receive deposits from customers and pay them interest on that money. This is like your own bank account, your own savings account that pays you interest. And banks generally pay low interest on the amount that people have deposited. The money that people put in the bank is a liability to the bank, meaning that the bank has to pay that money back when the depositor wants to withdraw it. But this deposited money also provides a resource that the bank can invest to make more money. Banks loan that deposited money to others in return for higher interest than they pay for the deposits. For example, you might receive 1% on your savings account, but the bank might loan that out for 6% to somebody else's home mortgage. That 5% difference provides the bank with an opportunity to make a profit. But banks have limits on the amount that they can lend out. Basically, banks have to have enough cash on hand to meet all outgoing cash expectations for 30 days. The goal is to avoid cash shortages that could put the bank at risk of everyone taking their money out at the same time and leaving the bank without enough money to survive. So the bank can't invest all of those deposits. It has to keep some money back as cash or as liquid assets that can be turned to cash very quickly. Before and during the COVID pandemic, both personal and business savings rates soared, leaving banks with more deposits than they had previously and giving them more security or having higher deposits to work with. Silicon Valley Bank's average deposits soared during these years. From 2010 to 2020, SVB deposits increased from $12 billion to $75 billion. These growing deposits provided banks with the opportunity to invest more. As long as they meet those liquidity requirements, they can invest as much as they want. Bank investments are generally loans made to others. This could be loans to people to buy houses, loans for companies to grow, car loans, and even loans to the federal government through treasury bonds. As long as the bank receives more interest than it pays out, it can make money. But they always have to keep enough money on hand to meet those liquidity requirements. In the years prior to 2020, tech firms started to grow, and then it really took off during the COVID pandemic. These companies had a lot of money to deposit in the bank, so Silicon Valley Bank's deposits exploded. After huge growth in the previous decade, SVB's deposits ballooned from $50 billion at the beginning of 2019 to a peak of $192 billion in the second quarter of 2022. They had a lot of money that they could invest in other loans at the same time that interest rates dropped. Although a low rate is great for you and your home mortgage, it's bad for the bank. They need high rates for them to be able to make money. And along with those low mortgage rates, treasury bond and other interest rates dropped as well. Banks simply weren't making as much money on their investments. Along with many other banks, SVB invested a lot of money in low-interest government bonds. And then Jerome Powell and the Fed started raising interest rates. And that made the previous low-interest bonds fall in value. If anybody was going to buy those low-interest bonds, they would want to buy them at a lower price so that they could still make some money. So the value of bonds held by SVB went down, and the other piece of that puzzle, or the other piece of that equation, has to do with the deposits that customers had put into Silicon Valley Bank. Remember that banks do better when their deposits from customers are high. With high inflation and a slowing economy, growth in the tech sector slowed. It's so bad that tech companies are facing huge layoffs right now. And with these challenges, companies started pulling their money back out of banks, reducing Silicon Valley Bank's deposit amount. After reaching a peak of $192 billion in the second quarter of 2022, Average deposits at SVB were down to $175 billion in the fourth quarter. In order to raise enough cash to meet liquidity requirements, Silicon Valley Bank sold $21 billion worth of bonds. But the problem is they weren't worth as much, so they took almost a $2 billion loss on that sale, and customers kept pulling their money out of the bank. So now Silicon Valley Bank had fewer deposits at the same time that they were also taking a big financial loss. It was a shaky situation. Depositors got concerned and started pulling even more money out of the bank, a classic bank run. SVB needed even more cash to meet requirements. They tried raising money by selling stock in the bank, but that scared investors even more, and the stock price crashed. They simply couldn't raise the money. Silicon Valley Bank doesn't have enough money to meet federal requirements, so the bank failed and the FDIC took over. So what happens to deposits if the bank fails? The FDIC insures your deposits for $250,000 per customer, or $500,000 if it happens to be a joint account. As long as accounts are within that limit, your money is safe. But if you have more money in a bank account than those limits, you could lose the remainder of that. And that's why tech companies got so scared and started pulling their money out of the bank faster. Silicon Valley Bank made two big strategic mistakes. For one, they had too much of their business in technology and startups. When these industries struggled, they pulled their money out, leaving Silicon Valley Bank in trouble. A more diversified customer base would have helped a lot. The other big mistake that SVB made was investing so much of their money in low-interest bonds. Any finance student can tell you that when rates increase, the value of bonds will fall. Banks should have kept more of their cash on hand because we all knew that those super low rates were not going to last forever. And now a lot of people are going to lose money. But will the same thing happen at your bank? Probably not, unless your bank relies too much on a single industry that starts to struggle. But even if your bank fails, remember that your money is safe as long as it falls below the FDIC amount of $250,000. I hope you found this explanation to be helpful, or should I say, I hope you like it. Please subscribe for more on business, strategy, and the people involved.